In this video, we explore whether the UK property market is going to crash or not by looking at facts, statistics, data and trends over the past and in history.
For so many, owning a home is a dream. For so many, it's a dream increasingly distant.
Well, in one sense, what everyone's wheelhouse should be is we should be thinking about where the next risks are coming from.
Well, the government seems to be very keen to stimulate the housing market. It's worth noting the housing market is already highly stimulated with prices at a record high.
More buyers are paying well over the asking price, estate agents are going to last and final sealed bids, and the London market is going pretty flat as more people start to hunt and search for more space in the countryside. But going back to 2007 and 8, there are still a lot of recent scars in the property market where people won't really understand what to do next or whether they should buy or sell or hold and what to do. The headlines in the news are really confusing. You've got some headlines saying that property prices are booming and going up and that 2022 is going to be an incredible year, and then you've got some news places that are saying that everything's going to go wrong, house prices are going to crash. So what actually is going to happen? So let's explore this in 3 stages. Firstly, where we are today and what's happened so far. Secondly, the signs and indicators of where we're heading. And thirdly, looking at the data and trends and statistics to understand where we also could go in the future. Firstly is low interest rates. Now, the Bank of England reduced the interest rates to 0.1%. This is known as the Bank of England base rate, although it has just gone up to 2.5%. It's still really low compared to what it was many years ago. Now, this means that banks can borrow money from the central bank in this country really cheaply, and therefore they can pass that on to me and you, the customer, meaning we get great rates on loans, on credit cards, but most importantly on mortgages. Because the rates are so low and the banks don't need to pay that much, they don't need to make as much of a margin or a profit, hence that's why they can pass it on to us. So as rates go up, it means that banks have to pay more themselves, and for them to make a margin, they have to pass that on to us as well as consumers. The only downfall of this is that when interest rates are really low, it's great for lending money, but when you're depositing money into a savings account, that explains why the rates are so low, because the bank don't really make much on your money compared to when interest rates are higher, because they can't lend it out for as much money. And with mortgage interest rates so low, it means that more people are getting onto the property ladder, the property market becomes even more booming and hot as a whole, and it also means that more people are borrowing more money because they can afford it. And that's why we're seeing 95% loan to value mortgages compared to the traditional 75% loan to value mortgage. This means more people are borrowing more debt on their mortgage, and there's less room in case property prices do go down a little bit. There's a greater risk that they could end up in negative equity. Next is the furlough scheme. Although a lot of markets and everything stopped in 2020 during all of the lockdowns in the middle of the pandemic, furlough became a thing in the UK, which essentially funded people's salaries and kept the economy ticking over. Otherwise, stopping everything in the UK would have meant absolute carnage for the UK economy. So the furlough scheme kept things going and almost delayed all of those impacts that COVID and the pandemic could have had. We then have the stamp duty holiday as well. This meant that any homes up to a total value of £500,000 didn't pay any stamp duty, which is a huge tax saving on £500,000. This also fueled the property market and got people moving. This also meant that people were going for more expensive homes, but this created a problem. Because there's a stamp duty tax break and then the market becomes more and more hot, all it means is that buyers get into bidding wars and house prices really start to skyrocket. So in reality here, even though you're saving more on tax, you're probably going to be paying more in the purchase price of the property anyway because of the heat of the market. So it isn't really beneficial. And lastly, the government released their Build plan. Now, this is all about completely reforming the planning laws and the planning process in the UK, which is very historic and very painful and run by retired people in local parish councils, which means that bad decisions are often made on the council's part, which then has to go through to appeal. Now, since I've been born, and regardless of what government are in power at any one time, every single year they have always failed to meet the housing targets that they set every single year. According to the Office for National Statistics, there are about 67 million people in the UK at the moment, but there are only around 28 million homes. This means that there has to be over 3 people per household, which we know isn't realistic because some people live on their own, some people live as couples, and then you start to get your families of 3 and 4. But there is a big shortage of housing in this country. Hometrack release an awesome report every single month looking at the state of the UK. Now, I've got the results here on my laptop, but we've seen over the past 12 months that Liverpool has had a 10.6% year-on-year growth, which is absolutely phenomenal. Manchester at 8.7%, and also my stomping ground, which is Sheffield, with 8% in their property prices year on year. The Halifax House Price Index also shows that prices have been rising over the past 5 months, every single month without fail, and it's now at a 15-year high. The average UK property price is now £273,000 on average, and quarterly house inflation is now well above what it was in 2006 and 2007. But when you compare all of this excitement and heat in the market compared to London, London has grown about 1% over the past 12 months, so it's really stagnating behind the rest of the UK. So now let's explore where we're going in the future. There's a guy called Fred Harrison who coined a theory about the 18-year property cycle. Now, it's not entirely accurate, but give or take, it has roughly followed a trend over the past 200 years. And Fred discovered that this has been true for a long, long time, where every 18 years, properties go through a very, very similar cycle. So you have your recession and your big crash. From this point, it takes about 3 to 4 years for the whole crash to take full effect. From there, you then enter the recovery phase. This takes several years. As property prices start to go up in the market, you then have a bit of a mid-wobble dip, which we've just gone through just now after Brexit and through the pandemic as well, which was very conveniently timed. After you have the mid-cycle wobble, that's where you hit another several years of explosive growth, which can start to explain why we're seeing such a hot market at the moment, on top of external factors like the pandemic and forcing people to want more space in the countryside. But then after those several years of rapid growth, you then start to hit what is known as the winner's curse. Now, this is the peak of the explosive phase. This is where confidence is massive in the industry and loads of people are borrowing more money, buying bigger homes that they probably can't afford if the interest rates go up. This means if they buy at the peak and then property prices crash by 15 to 20%, as they usually do in a property crash, they are in massive negative equity for another few years to come. With big companies like Lloyds Banking Group and John Lewis trying to get in on the action of being in the rental side of the market and purchasing properties, there really is great confidence in the market at the moment. And if big companies like John Lewis and Lloyds Banking Group are doing this, then that shows that there is a lot of strength in the market in the future, and they have done their homework into this. Having worked at Lloyds Banking Group and also interviewed for a role at their new Citra Living part of the investment arm of the group and the equity arm of the group, they had some awesome plans, but it's not about snatching homes from everyday people. What they were trying to do is look at a new build site and how they can help fund even more homes that they wouldn't have otherwise done, and they then own those homes that they've funded. So it's adding additional stock into the UK. It might not be the best news for buyers in the world, but from a rental perspective, it shows that there is huge confidence in the market. So here's my thoughts on the property market over the next few years ahead, and this is purely my opinion based on what I've looked at in the data and the stats. So I think we'll have a few more years of boom in the market. There's going to be loads of competition, the bidding wars are going to continue, and it is going to be a seller's market where people who have space and big houses will definitely be making good amounts of money. But then at the same time, as the pandemic settles at some point in the future, I think people will start to really think about what is it they want in life, and they'll really start to think about, is it a big house or is it a flat/apartment in the city? And there'll be more of an equal balance between flats and apartments, which are currently flat, versus the demand for homes in the countryside, which I think will go down a little bit, but still overall up and very hot. Either way, both London and the countryside are going to have increased demand over the next few years. We're already entering, in the property cycle, the explosive phase, so it's going to be a wild ride for the next few years, and then at some point we'll hit the peak, and then we'll definitely see the next property crash. With a few more years to go, I think we'll definitely start to see the Bank of England rate start to increase over time above where it is now at 0.25%. There'll be a huge increase in market confidence on top of what we already have today. This is where you'll start to see the next biggest skyscraper or the next biggest shopping centre and these huge commercial property projects where they're breaking new records, because lending and confidence in the market is so high, it means that the money is readily available to invest into these projects. After about 2025 to 2026, that's when I'll be really starting to watch the market, because that means that we would have had time to go through the explosive phase, and we're starting to get somewhere near the top of that property peak before the next recession, if the 18-year property cycle rings true. Now, it's not always accurate, and it's always a bit of a give or take for every few years. It's not exact bang on the 18th year, but after 2025 for me, that's when I'm going to keep a really close eye on what's happening. This is all purely based on my view, but the reality is with the property market, if you look at it from a long-term perspective, then property prices always go up. In the UK, we have a tiny island with a growing population and not enough houses. So from a supply and demand perspective, property prices will always go up in the long term. So it doesn't matter whether you buy today or whether you buy in a few years, if the property prices go down, it's still going to go up in the long term, and that's what it's all about. Just get in now rather than waiting, because if you want to wait for another year, it's likely that the property prices, especially at this time, are really going to shoot up, and it's going to cost you a lot of extra money to buy that house in the first place. So just get in there, enjoy the process, and treat property as a long-term investment. There is a lot of scaremongering out there. The news headlines are created to sell stories and get loads of clicks. There are loads of YouTube videos out there with really poorly written conclusions with no research in the videos whatsoever. So you have to be careful and take all of these things with a pinch of salt. If you're buying property for the long term anyway, then that's what this is all about. It's not about looking at when is the best time to get in. If you get in and ride it through the long term, then you'll definitely benefit from growth over time. And this is exactly what Warren Buffett did and why he got into investing at such an early age.